Good morning, traders, and welcome to BCI's morning market analysis. Here's your quick rundown of the markets to kick off the week. First off, let's have a look at the US dollar index, which started last week under pressure, dipping close to about the 97 level. But by the weekend, it managed to bounce back thanks to optimism around global trade negotiations and some dovish signals from central banks. The dollar is now hovering around 97.6, recovering from oversold levels. Still, it's struggling to shake off the steep weekly losses. Traders are now looking ahead to the next week's Fed meeting, with the market still digesting news of a potential US-EU trade deal that would impose a 15% tariff on most EU goods, similar to the recent agreement that the US had with Japan. On the monetary front, the Fed is expected to hold rates steady as it watches how near a new tariffs play into inflation. President Trump's turn towards Fed Chair Powell has softened following a historic visit to the Fed building, saying he has no plans to remove him. Markets are now pricing in around 43 basis points in cuts by the end of the year, with expectations building for moves in both September and December. Technically, the index remains fragile. It's still below its 50-day simple moving average at 98.36, and yet hasn't reclaimed the key pivot at 97.66. Without a clear higher low forming, especially above the July low of 96.38, this bounce may be short-lived. Resistance remains at 98 and 98.36, while a break above 98.93 and the psychological level of 99 would be needed to shift momentum higher. First downside support is at 97.10, with 97 and 96.38 below that. Next up, let's have a look at WTI crude oil. WTI futures ended last week lower, settling around 64.85 per barrel, its lowest level since the 20th of June. Crude fell about 1.8% on the week, pressured by weak signals from the US and China about concerns about rising global supply. Optimism around trade deals with the EU and Japan helped cushion the downside. The US is also reportedly allowing Chevron and others to resume limited operations in Venezuela, which can potentially add over 200,000 barrels per day to the export mix. Meanwhile, all eyes are on the OPEC meeting today, where the group is expected to announce a production increase to meet peak summer demand. Domestically, US rig counts continued to decline and now down for 12 of the past 13 weeks, hinting at a weaker future output. Technically, WTI remains in an upward consolidation, still trading above the 65-day SMA at 64.19. The RSI is near 46, and the MACD is showing growing bullish momentum. If crude can break above the 200-day SMA at 67.73 and this week's high at 68.36, it could move towards the $70 psychological level. However, oil struggled to hold above the 67.08 resistance last week, retreating after repeated rejections. The key support lies between the 65-day SMA at 64.19 and the round number $63 and the 80-day SMA at 63.72. Next up, let's talk a bit about gold. Gold finished lower for a second straight week, currently hovering around 337 per ounce. A cooling of tariff tensions has taken some shine off safe haven demand. Still, investors are keeping close tabs on US-EU negotiations following a confirmed trade deal between the US and Japan. Meanwhile, US jobless claims have now declined for 6 straight weeks, pointing to labor market strength and supporting the Fed's likely decision to keep rates steady next week. That said, markets continue to price in a possible rate cut in September. Trump and Powell also made headlines again last week, clashing over the cost of Fed building renovations. Trump repeated his call for rate cuts, but said the issue wasn't grounds for dismissal. From a technical standpoint, gold is consolidating within the 3,300 to 3,340 range. Bollinger Bands are narrowing slightly, with resistance at the upper band near 3,407 and support at the lower band around 3,284. The RSI has dropped to 48.5, indicating no clear reversal yet. If prices fall below the midline of the Bollinger Band at 3345.9, downside targets could include 3326 and $3,300, and a deeper support at 3285. But if the Fed signals a more dovish outlook this week, gold could regain momentum and retest resistance at $3,400 and 3409, and last week's high at 3439. Lastly, let's have a look at the Australian dollar, which pulled back slightly last week after briefly touching an 8-month high of 66.25. It's now trading just above the 66-cent mark following a profit-taking move after a strong run. The rally had been supported by improving risk sentiment and a solid Australian PMI reading of 53.6, the strongest in over 2 years, which helped cool expectations for an RBA rate cut. Optimism around global trade, especially Trump's announcement of a major agreement with Japan, also gave risk assets like the Australian dollar a boost. Meanwhile, broad measure of pressure on the US dollar continued, with markets already pricing in a rate cut as soon as August. Technically, the Australian dollar remains in a bullish structure. The pair has posted 4 straight bullish candles and is now trading between the midline and the upper Bollinger Bands, with the midline support rising to 6551. Key support lies at 6525 and 65 cents, while the lower Bollinger Band at 6483 offers deeper support. Momentum remains constructive, with RSI rising to 54.41 and the MACD shifting into positive territory. If the pair can stay above 6595 and 66-cent zone, the upside targets are 6687, which is the high from November, and the 67-cent psychological level, with long-term potential towards 6750. Well, that's all for today's morning market update. Keep an eye on tariff headlines and Fed commentary. They're likely to remain key drivers throughout the week. Have a great trading day ahead, and as always, manage your risk and happy trading.